Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Unlocking the World of Swaps, a comprehensive guide for 2024. Swaps are essential tools in finance, allowing parties to exchange cash flows or financial instruments. They can help manage risk and can be tailored to meet specific needs. Whether it's interest rate swaps to hedge borrowing costs or currency swaps to navigate exchange rate fluctuations, these instruments play a key role in financial markets. In this video, you'll learn what swaps are and why they matter. We'll break down the different types, including interest rate and currency swaps, and explain how each functions. By the end, you'll have a clearer understanding of how swaps can benefit your financial strategies. Ready to unlock their potential? What are swaps? Swaps are financial agreements where two parties exchange cash flows or financial instruments. These transactions are designed to help manage risks associated with interest rates or currency values. Swaps can be tailored to fit the specific needs of contracting parties, serving as effective tools in a company's financial strategy. Overview of swaps. In the financial world, swaps are often used to address uncertainties related to changing market conditions. Through these agreements, companies and investors can stabilize their cash flows and reduce exposure to unfavorable market movements. For instance, if an organization has a variable interest rate loan, it might enter into a swap to convert that loan into a fixed rate, thus locking in predictable payments. Purpose of swaps in financial markets. Swaps play a significant role in financial markets for several reasons. Risk management. They help parties manage risk associated with fluctuating interest rates and currency exchange rates. This allows businesses to focus on their core operations rather than worry about market volatility. Cost efficiency. By using swaps, companies can often obtain better interest rates or exchange rates than they would get through traditional borrowing or currency transactions. Investment strategy. Investors use swaps to enhance their investment portfolios. By swapping cash flows, they can adjust their exposure to different assets, making their strategies more flexible. Types of swaps. Swaps come in various forms, each with its purpose. Interest rate swaps. In these agreements, one party pays a fixed interest rate while the other pays a variable rate. This helps companies manage their interest expenses more effectively. Currency swaps. These swaps involve exchanging principal and interest payments in different currencies. They are often used by companies operating internationally, allowing them to hedge against exchange rate fluctuations. Commodity swaps. These involve exchanging cash flows related to the price of a commodity, helping businesses stabilize costs associated with raw materials. Conclusion. Understanding swaps opens up a new avenue for better financial management. These instruments not only serve specific needs but also allow companies to navigate market challenges more efficiently. As we explore the different types of swaps further, you will see how they can support your financial strategy. What challenges have you faced that swaps could help address? Types of swaps. Swaps can be categorized in several ways, each type serving a specific purpose in finance. Understanding these different swaps can help you make informed decisions and tailor your financial strategies. Let's break down the main types of swaps. Interest rate swaps. Interest rate swaps are agreements between two parties to exchange interest payments on a specified principal amount. Typically, one party pays a fixed rate, while the other pays a variable rate that fluctuates with market benchmarks. This arrangement helps manage interest rate exposure. For example, a company with a variable rate loan may enter into an interest rate swap to pay a fixed rate. This locks in predictable payments, making budgeting easier. Common use cases include hedging. Companies can protect themselves against rising interest rates. Cost savings. Firms may take advantage of lower fixed rates compared to variable rates. Currency swaps. Currency swaps involve exchanging principal and interest payments in different currencies. This type of swap is particularly useful for companies dealing in multiple currencies or looking to hedge against currency fluctuations. In a typical currency swap, two parties agree to exchange cash flows in their respective currencies for a specified period. Benefits of currency swaps include hedging currency risk. Firms can protect their international operations from adverse exchange rate movements. Accessing foreign capital. Companies can secure financing in foreign currencies without directly borrowing in those markets. Commodity swaps. Commodity swaps function by exchanging cash flows related to the price of a commodity, such as oil or metals. These swaps are essential for businesses reliant on commodity prices. By entering into a commodity swap, a company can stabilize its costs for raw materials. For example, a manufacturer may want to lock in a specific price for a metal it regularly purchases. Key scenarios for using commodity swaps include cost stabilization. Companies can manage expenses linked to volatile commodity prices. Risk management. Firms can hedge against price fluctuations that might impact their bottom line. Credit default swaps. Credit default swaps, CDs, are financial contracts that allow one party to transfer the credit risk of default on a debt instrument to another party. Essentially, a buyer pays a premium to a seller in exchange for protection against default. CDs play a significant role in risk management and financial markets. They help investors manage exposure to credit risk and evaluate the health of the underlying debt. Some notable aspects of credit default swaps include risk transfer. Investors can reduce potential losses from credit defaults by purchasing CDs. Market signals. CDs prices can indicate perceived risks associated with specific companies or sectors. Understanding these types of swaps can enhance your financial strategies. They offer ways to manage risks and stabilize cash flows, providing flexibility in various market conditions. What type of swap do you find most intriguing, and how could it apply to your situation? How swaps work. Swaps are more than just agreements, they are structured transactions that help parties manage financial variables. Understanding how they operate is essential to navigating the financial world effectively. The mechanics of a swap agreement. A swap agreement starts when two parties identify a mutual need. One party might want a fixed cash flow, while the other prefers a variable one. After initial discussions, they agree on the terms, including the notional amount, payment frequency, and time duration. Once the contract is drafted and signed, both parties exchange cash flows. This typically happens at set intervals. Payments are based on the terms outlined in the agreement. At the end of the contract, there may not be any principal exchange, as the swap primarily involves cash flow. Here's a simple breakdown of the process. Initiation. Parties identify their needs and agree on terms. Contract creation. The swap agreement is formalized in writing. Payment schedule. A timetable for cash flow exchanges is established. Cash flow exchanges. Payments occur at the agreed intervals based on the swap terms. Settlement. At the end of the swap, parties close out their obligations. The entire process simplifies complex cash flow management while allowing parties to reduce risk based on interest rate or currency shifts. Valuation of swaps. Valuation is a critical aspect of swaps. Understanding how they are valued can help assess their benefits. Swaps are valued based on the present value of expected cash flows. This involves calculating how much those future cash flows are worth today. Here are key points to consider. Present value calculation. The future cash flows of the swap are discounted back to the present using an appropriate interest rate. This rate reflects current market conditions. Market value. The swap is worth the difference in present value between the fixed and floating cash flows. If fixed cash flows are greater, the swap may have a positive value for the fixed rate payer, and vice versa. Credit risk. The valuation also considers the credit quality of the parties involved. If one party has a higher risk of default, it affects the overall value of the swap. Valuing swaps provides insight into their worth in the financial market. It helps parties make informed decisions about entering or exiting agreements. Would understanding swap valuation change how you view these financial instruments? Benefits of using swaps. Swaps offer multiple advantages for companies and investors. From managing financial risks to enhancing cash flow, these instruments can provide significant benefits when used effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.